Imagine a company celebrating record-breaking profits on Tuesday, only to realize they are missing payroll by Friday. It sounds like a mathematical impossibility, but under standard accounting practices, revenue is recorded the moment a sale is made, regardless of whether the client has actually paid the invoice. A business can be wildly profitable on paper, while its bank account is entirely empty. This split-screen chart illustrates the exact trap. It is a phenomenon known as the profit illusion. Fast-growing companies are especially vulnerable because scaling operations often drains liquidity long before those new revenues convert into usable cash. Measuring survival by profit alone is financially fatal. Profit is a measure of theoretical performance. Cash is the actual lifeblood keeping the doors open. Take a look at this timeline. When a deal is signed on day one, the books immediately register success. But if the payment terms dictate a 45-day gap before the cash actually clears the bank, the business still has to fund its own operations during that entire waiting period. During that gap, capital gets quietly trapped. It sits in unpaid invoices, piled up inventory, and vendor obligations. The company is bleeding liquidity while the profit and loss statement looks flawless. Navigating this blind spot requires a virtual CFO perspective, someone who uses the books to actively manage upcoming risks. Strategic forecasting begins with a ground truth baseline. A virtual CFO relies on 6 to 12 months of actual bank history rather than optimistic estimates. This process requires stripping out the noise. Identifying and removing personal owner draws or one-off anomalies ensures that only the true operating rhythm of the business remains. This animation shows the next crucial step. The clean data is sorted into specific cost behaviors. Rent and software subscriptions go into the fixed channel, while direct materials and shipping costs go into the variable channel. Mapping these behaviors allows the budget to act as a realistic model. If revenue spikes, the variable costs automatically scale up to reflect reality, while the fixed costs stay grounded. A budget built on a cleaned, behavior-mapped historical baseline provides the specific evidence needed for reliable financial modeling. With a solid baseline established, the CFO looks at the short-term horizon using a 13-week cash flow forecast. There is one absolute rule for this tool. It must begin with the actual reconciled opening cash balance from the bank. If the starting number is an assumption, every week that follows will be inaccurate. In this rolling grid, we map out weekly inflows and outflows, explicitly adjusting for those dangerous timing lags identified earlier. We track the exact dates payroll and vendor payments hit to see exactly when the liquidity drops below zero. A CFO then stress tests this model. By running a worst-case scenario, such as a 30-day delay in major client collections, the hidden breaking points of the business are exposed. Forecasting is not about achieving perfect prophecy. It is about gaining enough visibility to execute a backup plan before a tight week turns into an emergency. Once the forecast meets reality, the CFO performs variance analysis, the disciplined process of comparing what we projected against what actually happened. Look at how this dashboard isolates a single missed target. The CFO investigates the root cause, determining whether the business underperformed because of a pricing error, a drop in sales volume, or just a temporary delay in timing. Context dictates the threat level. An unfavorable variance on shipping costs might just be a harmless timing quirk, while a favorable variance on marketing spend might mean the sales pipeline is about to dry up. Ultimately, identifying a mathematical discrepancy has no value on its own. The analysis only matters when it translates into a specific operational correction. Modern AI agents can ingest raw financial data, categorize expenses, and assemble a baseline 13-week forecast in seconds. But there is a strict limitation to this technology. An AI can calculate and organize data at incredible speeds, but it cannot take professional accountability for a strategic recommendation. AI provides the speed of execution. Human judgment remains the actual product being sold. The virtual CFO delivers something far more practical than raw data: clear actions, assigned owners, and strict deadlines derived directly from the numbers. This system puts the advisor in a position to help shape upcoming business outcomes. By mastering cash flow confidence, you can look past the illusion of profit and ensure the business actually survives to enjoy it.